Hello and welcome. You're watching Informed Investor, brought to you in association with the National Stock Exchange. I'm Sumera Abdi. This week, Informed Investor has a very special episode lined up for you. We have some eminent personalities from all walks of life gathered in our studios, and you've probably seen them and even met them through the course of your life, but it's time now to talk to them about their investments. So let me start from the far corner. We have with us Vicky Ratnani, who's a chef consultant, gourmand, and a food connoisseur, and now an author. His book, Vicky Goes Veg, will be out in Feb. Next to him is Cyrus, who insisted that he not have an introduction, but he still worn a pink shirt to stand out from the rest of the crowd. We have with us also Babita Malkani, who's a fashion designer, and Ayub, an actor, again someone who doesn't need any introduction. He's on your TV screens every evening.
Thank you.
We have also Dinesh Vazirani, who's the co-founder of the Saffron Art Gallery, and finally with us are our experts, Harshvardhan Roongta and Dipan Mehta. Thank you so much for taking the time out to be with us. I want to begin not by asking any questions, but I want to just know how the year has been financially. Are there investments that have worked out, and is there anything that you think financial resolutions that you'll be making for the next year?
I don't know. Most of my money is in Greece at the moment, and unfortunately,
not a good idea.
Not a good idea.
It's going to turn out to be a Greek tragedy.
Let's ask the ones with the let's ask Saffron Art. They're the ones with the businesses. See, we work and get paid for certain events. Ayub and me, I think, will be last.
Yeah, last, no? Completely last.
Dinesh?
You want to start?
So, okay, I can talk about the art world. I think the art world over the last year has changed quite a lot. Modern art has done very well. Contemporary art, unfortunately, has got a little bit of a beating. There's a revival now, and people are looking at it. So I think for next year, I think contemporary art is something to look at very seriously if you want to invest your money, because it is a good value.
Do you see a lot of interest now from
There's
retail
a lot of interest.
investors?
A lot of interest within India.
Okay, what about you, Ayub?
We, as actors, do not really have funds to really take and put into big investments. So we have to just make sure that we keep breaking it up, and that's how you build up your investments. I have been investing in property, and I have just started investing in property outside Bombay. I do also believe that investment outside India is very favorable because the markets are not that bullish anymore. So this is the right time to invest outside India.
In fact, Harshvardhan, this is a point I want you to pick up on, because we're seeing a lot of people who are now freelance professionals, and Ayub raised that point where he said that, income may not be regular. Sometimes, it's a lot. Sometimes you're waiting out, or you're investing in yourself, in your businesses. What's a good strategy for someone with...
What I wanted to know is, what is the percentage of what you earn that you should keep aside for investment?
Well, Ayub, to begin with, you need to at least save 20% of your earnings towards making to achieve certain goals. What Ayub is rightly doing is that if he has certain access to certain amount of money at one point in time, he needs to park it into assets which require that kind of an inflow.
Right.
So real estate particularly has that requirement where you need to invest a large chunk of money yourself, even if you're going for a housing loan. Even 20% needs to go in by yourself. And rest amount can be amortized over the next 5 years, 10 years, 20 years.
I want to talk about art for a little bit before we move forward. I know you specialize in equity, but is there perhaps an investment or case to be made for investment in art? I know it's picking up, but do you suppose vis-a-vis equities, would you advise someone to perhaps, for the pure sake of diversification?
See, I don't understand art, but you have to admit that it has done well for a lot of investors and has given very good returns. And I think the principle over there is that whatever is rare will get expensive as the years go by, because not many of it is getting produced. But having said that, I think what is important for everyone, including all the celebrities here, is to have a good, strong look at their savings and do a very intelligent allocation. For example, we have a thumb rule: whatever your age is, that percentage you must put in risky assets. Could be equity, could be real estate, could be art also. And when you talk of risky assets, I would say equity, a larger portion of it over there, because of liquidity factors, because of past returns, and because of the ease of investing and the tax breaks which you get. But within the risk part also, I would say large percentage in equity, and there too, you could make intelligent bets on the large cap companies, which are growing at 15-20%, which are, totally domestic oriented, the likes of ITC or Hindustan Unilever, or in some of the banks.
Which are the Hussains of the equity world.
The absolute bluest of blue chips.
Yeah. I'd just like to add one part on how art is picking up within retail investors. One, it has been a domain of, actually HNI still now. The reason being because to identify an artist, to value that product, it's very difficult for a retail investor to do.
And to be able to afford that product, surely.
Yeah, but affordability, I'm sure there is a full range. There's a wide band. You can start with a couple of thousands and go up to a few lakhs.
There are several publications, there are websites, there's a lot of information available about art. We were talking earlier, and it's just, there's a percentage of wealth in every country that people put into things which are called treasures, which is gold, silver, art, objects, etc., collectibles. India is probably the lowest in the world. It's about 2%, out of which 1.5% is probably gold. So there's a very small percentage of people's wealth that actually is going into alternative assets.
Yeah, Babita, you're a big investor in those treasures. How much of that 1% are you owning?
I believe in investing in gold. I think this is fake. So gold has been a good investment for me. So I believe in that. Gold and real estate.
Can we ask a question? Are we looking at short term? What can we get? When we're looking at short term?
From gold?
From gold, silver, what he calls the treasures.
See, what happens with gold is normally it's an hedge against inflation. So what is an hedge against inflation? Whatever your rate of inflation is, technically that much is the returns gold is supposed to give. Now what has happened in the last 2 and 3 years is exceptional. So if you take that as a benchmark and invest into gold from here on, you would probably be wrong.
And I want to ask you, because we were talking about tax breaks earlier. You're new to the entire concept of taxes.
Yeah, I mean, I used to work overseas for like 16 years. I just want to know that as it's coming to the end of the year next year, what are the best things you think you should invest in?
I think that you need to get an advisor for you. Try not to do it by yourself. And even when you are, looking at suggestions which your advisor or stockbroker has given you, have a look at the companies which you are investing in. And I keep repeating that you have to buy the bluest of blue chip companies. And within the Nifty also, there are certain allocations or weightages, like banks have got about 25% weightage, then technology about 20% weightage, pharmaceutical stocks 15-16% weightage, and so on and so forth. That's all in public domain. So when you're structuring your portfolio also, if the weightages in your portfolio are similar to the ones which are there in the Nifty, then that's a good way of at least getting returns which are at par with the Nifty. Because one of the problems you find with investors is that they feel the markets have gone up, but their investments have not done as well. That's because they're not investing in the right sectors, which are, actually the growth sectors, and which are actually well represented in the major indices. So that's one aspect. And just to come back to the tax breaks, see, the reason why the government is giving you so many tax breaks is because it is encouraging you to invest in a sector which is highly productive for the nation as a whole.
When you bank with a multinational bank, and then they ask you that, if they can handle your funds, and then they ask you to invest in companies, and you as a layman, you don't know what to invest in. So you say, what are the categories that you can invest in? Now, how does one figure that out, that, in this market, which company does well? Because you think infrastructure, it should be growing.
It's important to be well diversified into a lot of industries, point number one. Another good suggestion I'd like to make is that, to try and grow the equity gradually. I mean, in equity, the best way it works is don't make any sharp moves like getting in one chunk and getting out in one chunk. And the best time to invest, of course, when the markets are down, and see what returns you are getting after 2 years, 3 years, and then add some more after that. And it's like a process, and the mental framework has to be such that this is a part of your wealth which you will bequeath to the next generation. But if you have that mindset that you want to be in it for 15 years, 20 years, 30 years, then it will work phenomenally for you.
That's a lot of time.
And for all those time, you need to spend
a few... And that's not a game of blackjack, that
you need to spend a few Sundays also researching where you're investing, because that's very important. I know you all have advisors, but you need to also keep track of your advisors. We'll come back, because I know this is a discussion that could go on for a while. We need to take a very quick break. Be back in a bit. Stay with Informed Investor. Welcome back. You're watching Informed Investor. It's a very special episode that we bring to you this week, and we have a whole lot of eminent personalities who are here in our studios, and I'm sure you'll recognize all of them by name, so I'm not going to go through it by face. I'm not going to go through it again. But Vicky, I believe you had a question that you'd been meaning to ask.
So what do you think is your advice for the next year? Where all are good areas, and where I mean, I don't make big money, but where I can put a little money.
Let me explain to you. You have to pay these gentlemen lots of money for them to make you money. You can't come on this couch and just ask them questions.
Vicky, how would you go about with your investments? It's the first level you need to actually draw up how much money are you going to save out of your income. Then the question of investment starts arising. Then you have to decide how much of it will it go into equities, which is shares, how much is going to go into debt. So that allocation is the first step that you need to do for yourself. Because the moment you overshoot in any one asset class, you're going to probably go wrong somewhere. If you can identify those stocks yourself, very good. If you cannot, then you can choose to park your money in stocks through mutual funds. Okay, and then you have whether I want to go into infrastructure sector. They have specific funds which say that they will invest only into infrastructure. They have a diversified portfolio. If you do not know which sector is going to do well, you can go and tell them that I want to give the money to a diversified sector fund or diversified mutual fund, and they will spread it across in different sectors as per their research. Then comes the debt part. On the debt investments, which is basically non-equity, which does not invest into risky assets, does not invest into shares of companies. Now in that there are lots of products or plans that are available. Now there are tax-free bonds. The interest that you earn on these bonds are tax-free in nature. So whatever you get in your hand is absolutely, there is no incidence of tax at all. So if you are into a high tax bracket, which means that you are into a high income category, you could possibly choose those bonds wherein all the interest that comes to you is tax-free in your hand.
Also, he has a high-risk job because, cutting vegetables and things. What about parking money in insurance? Is that a good idea?
Good, yeah.
Because we have a lot of old advisors who love this insurance and I don't like it at all.
Yeah, so there are two parts in insurance as well. One is wherein there is a savings element to it, which says that you park your money, there is some kind of growth that it will it will generate.
What is the value of that money?
So that's one part.
Later, 25,000 crores, but it doesn't mean anything.
No, absolutely. So that's one part of one type of plans that are available in our insurance. The other is a pure risk cover. We have yet not seen insurance grow to that level in India, wherein you could insure your fingers and you could do that professionally.
Going back to the other insurance, is it a good idea or not a good idea?
The savings part of insurance?
The savings part.
No, it's really not a good idea. It's not a good idea.
It's not something you would really advise.
No, absolutely not. Unless
there are so many options available now, so it's better to try and do it yourself, especially if you have a large enough pie, which a lot of you have over here. It's
but what I find very funny is that there is nothing stable over here. One day is this, one day is that. Today is a blue chip company, tomorrow is infrastructure, third day is pharmaceuticals. What do you think is the next big thing that's going? Next investment one should park their money in, which would be the next big thing?
If I wish I knew it.
Andazan.
See, what happens is that that's why you advise diversification and not to get focused on one single company or one single industry. Because a lot of investors, suddenly they find that they're 30-40% of a single company, and if that gets into some kind of trouble, then their savings are getting eroded.
What, according to you, is top of the line? Is it gold, infrastructure?
A bit of everything, but coming back to what sectors look good for the next year. I mean, coming from an equity background, always that would be my preference, but I could justify it by saying that anything which has not given you returns for 5-6 years is bound to do well over the next 2-3 years. It's just pure common sense. And something which has done well over the past 4-5 years will start plateauing off. So what has done well over the past 3-4 years or so, or even longer, has been real estate and gold. So we shouldn't expect them to give the same kind of returns.
Don't jump into that.
Exactly.
Your view on equity?
And equity has not gone anywhere for past 4-5 years. The returns have been flat when they should be at least 17-18%. So if equities have to go back to their mean of 17-18%, which means that over the next 3-4 years they should give at least 24 to maybe 30% as well.
But mutual funds have also not been.
They're all linked to the equity end of the day. So they are like a vehicle. So whether you can invest directly or through
2013 is a good time to go back into the market.
2013 onwards is a good time. We have a very major event coming in 2014. Markets generally do well before and after elections. We've seen that. After the elections, usually that's the typical honeymoon period for the government, and they try and do reforms, and that gets the market quite excited. So I would say that we are looking at a good kind of scenario for the next 24 months or so.
And also recently we've seen a lot of reforms come in, so perhaps momentum is on the positive side, and you might want to ride that wave. But let's take another quick break. Be back in a bit. Do stay with Informed Investor. Welcome back. You're watching Informed Investor. We're in our studios this week, and with us are a lot of eminent personalities, and they have a lot of questions that they're just waiting to ask. So go ahead. You wanted to know something.
Now, I was talking about this only, and I did ask him top of the line because it's very confusing. Advisors give you some other advice and someone else tells you something, and the portfolio doesn't move.
Basically, how do you choose an advisor is what you want to know.
No, I have a good advisor. Actually, I don't. I've kicked out 3 advisors.
You see, your portfolio hasn't moved and your advisor is good.
I'm actually thinking of hiring him.
But no, Vicky, you have also some questions that you needed answered.
I'm looking at investing in a business. So, savings and like for a professional, for a person who's in the arts field, like I want to set up my own eateries, a few eateries, and a couple of other things. So it becomes another burden onto me. Like
No, he wants you to invest in his engineering. It's a different question altogether.
that's off the, off the record.
It's very easy to find angel investors, PE investors, and they're looking out for professionals like you who they could back.
Can you give us the list?
Absolutely.
Yeah,
Absolutely. There are a lot
No,
of...
but I do believe that there is a lot of talk in the market where people want to park their money into local businesses. You know, gone are the days when they only looked at big companies that they want to do. Now they want to see which is this next small thing that is going to grow big, you know.
Absolutely.
So I see a lot of that. So you can contact me and I'll let
In
you
fact,
know.
restaurant businesses stocks have done exceedingly well. Jubilant Foodworks, which is the Domino's Pizza, has been the best performing stock for the last 2-3 years or so.
Sure. This is what just generally the food and beverages industry. Now, if it has been mentored by a person who's already well known, a PE investor or a venture capitalist is very comfortable betting his money on that.
But I find that everything is so speculative. You know, there's no basis to anything. It's all on speculation. Most markets that you invest in is all speculative.
I would say assumption. I mean, there are certain numbers.
I mean, too much of assumption.
But do you
Too much of
hear
assumption.
a lot of this that
There's nothing to
a lot of
signify
retail
numbers.
investors have the same concern that Ayub has, that there's so much speculation going on, and I know you favor those large caps and the blue chips. What do you say to a retail investor like this?
Avoid the noise. Speculation end of the day is just the noise. If you're focused, as I said, on the allocation and then you look at the stock selection, I think a simple thumb rule. Try buying into companies whose names you are familiar with. So what do you see around you?
So Mehta, his question was not answered. How to save money while starting a business?
Actually,
Tax breaks
also,
that you might get.
which should be a priority if you're setting up a new business or if you're expanding. Should you be prioritizing making investments at that point, or should you be perhaps channeling everything into your new business?
See, well, there are two ways to it. One, if you're setting up any new business, it is capital. It is going to guzzle up a lot of capital. You do not have a choice. At the same time, there are certain long-term goals that you cannot avoid. Your children's education, your own, if you have your retirement plan in place, you need to continuously also earmark some kind of money and keep aside for those requirements. And you'll be surprised to know that you really don't need to, set aside a lot of money every month to create a large corpus for your children's education.
Sure.
I know, you're into art, but now, post everything that you've heard, would we suppose that you might be investing also in equity now?
No, I've always invested in equity. I think, having a balanced portfolio, investing a little bit in equity. I think over the last year, I think most of my money has been in debt. I've invested almost nothing in equity. A very small percentage.
So you're good to go now.
Yeah. And of course, unfortunately, one of my addictions and one of my weaknesses is art. So every time I see a good painting, all the equity and debt goes to hell and all the money goes into a painting.
Well, that's the good thing about equity being a liquid asset, is that you can immediately liquidate
And art
it.
is not that liquid. So,
Art is not that liquid.
Well, given us the green light for 2013, we're all going into equity. And if anything goes wrong, we're staying in your house. It's our daughter.
He's put words into your mouth.
No, but just taking Dinesh's point further, he's made a very interesting point. He's investing in something he's comfortable in. And that's the most important aspect of any investment that you do, that some assets you're familiar with and you should kind of focus on those assets. Like you spoke about gold, and you're comfortable investing in it.
What are these, this gold bullion fund, what are these?
Yeah, well, basically, they're like mutual funds. They take money from you and buy physical gold. But the advantage is that you don't have to store the gold yourself or take care of it.
They store it for me.
Exactly. They store it for you, and you get the same return as gold.
You get a certain incoming.
So I can't wear anything.
Yeah, the other
can't
advantage
wear it.
is that when you need to sell, you don't have to be emotional about selling it. All right, so we really hope that 2013 turns out to be a very, very good year for you, and we hope your money is always working for you and that your investments work out really well. Thank you so much for taking the time out to be in our studios. Thank you so much, Harshvardhan and Dipan, for being with us, and also for your continued patronage of Informed Investor. So here's where we need to wrap up then. That's all we have for you this week, but do keep sending us your questions and comments, and we'll see you here with another episode next week. Bye-bye.